right, welcome, gang. Appreciate everybody tuning in today. We've got our third scouting report that we've set up, LFI Scouting Report that we've set up for the community. The goal with this is just trying to introduce more operators to the community and more the community to operators as well. So we've actually got 3 groups on today, so we're going to kind of rush through to make sure they have plenty of time. But we're going to start things off with Gary Lipsky from Break a Day Capital. Gary, go.
All right, thank you.
Go for it. Yep.
Thanks, Chad. Welcome, everyone. Good morning, good afternoon, depending upon where you are located. I'm the president and founder of Break of Day Capital, based in Los Angeles. So a little bit about us. We focus on the Southwest markets, particularly Arizona. We've done all of our deals in Arizona so far, a couple in Phoenix and a lot in Tucson. We've done a $250 million in real estate transactions. And our mission is to provide passive investors with superior risk-adjusted returns with the highest level of transparency and fiduciary responsibility while improving the quality of life and community for our residents. So we try to create win-win scenarios for our investors and for our residents. So a little bit about me. I've been investing in real estate since 2002. Been an entrepreneur my whole life, started in high school and been running businesses ever since. I have a best-selling book called Best in Class, and that is about asset management. I don't think there's any book out there on asset management, and so we wanted to write something that it forced us to get better, and it seems to there's not a week that goes by that someone doesn't reach out and thank me for that book, because yeah, like I said, there's really nothing out there on asset management. I host a weekly podcast called the Real Estate Investor Podcast. Again, pretty much based on on asset management, so definitely check that out. Previous life, I started a after school outdoor ed and leadership development company, and we worked with 9,000 students daily throughout Southern California. And I also started a nonprofit called Core Educational Services. This is our team. Joe actually was an investor of ours. He invested in 6 of our deals and invested in a lot more. And he wanted to end his retirement of just focusing on passive income, and he came on board. We have acquisitions and asset manager, operations, and a research analyst. So we are small and nimble, and focus on quality over quantity. Here are our core values: integrity, transparency, communication, diligence, and Kaizen. And for those that don't know what Kaizen is a continuous improvement. So I'll go over our track record. We've had 3 full cycle deals averaging 61% IRR, and that's taking advantage of market conditions and the right timing. We've never had a capital call. We never intended to do a capital call. We've done 2 adaptive reuse projects. So one, we bought student housing during COVID that was 52% occupied, and by the summer we were 95% occupied. And so we've had that just over 2 years, and we'll refi that out. We're doing that right now, and that'll be 100% return of capital to our investors. It'll be about 2.5 years by the time they get the money, and then we'll sell it in a more opportune time. So 2-3 years down the road, and we've done more than 23 million in distributions to date. So here is what we projected on our 3 deals that we sold and our actual. All right, and this is our portfolio that we currently have. Like I said, so 8 of the deals have been in Tucson. We love that market. A lot of owners fall asleep on that market. We find really true value add deals there. Whereas Phoenix, typically those deals are going to be picked over because they've been retraded every 2 years. It seems like the owners, buy a property and then never visit it because they just don't know the market. Because when we're buying these properties, we're getting $300 rent bumps just to market. and then even more on the renovated units, because they don't know where the market is. Business plan execution, asset management. This is where the rubber meets the road. If you follow a lot of social media, there's everyone's focusing on AUM and units owned and getting a deal, but how many are really focusing on what you do after you get the deal, that asset management piece? And using my experience for running other businesses my whole life, we've really focused on that, and that's why we've had such a we've always been our projections, because of our truly conservative underwriting and managing this property, managing the manager on every single step of the way, from well before we take over to all the way through disposition. And a lot of it is just that perseverance, solving problems, but we're very on top of it. So this is a little bit about our investment life cycle. We've been in the same markets. We're not shopping for deals all over the country. We focus, like I said, on a few markets so we can be experts on those markets. So we have great broker relationships. We've known these brokers for years. We see them all the time, whether we're visiting our current properties or looking for new ones. We have rigorous underwriting and due diligence processes. And we're highly focused on targeting assets that meet our criteria. On the asset management side, like I said, Kaizen earlier, it's that constant improvement. We're constantly pulling all these different levers to increase that NOI, and that all goes to our bottom line. The difference, your costs are basically the same at 90% to 95, 96%. Occupancy. So just that huge tweak could reap tremendous rewards, and that's what we're constantly focusing on. What other income lines can we increase or add? How do we keep our expenses in check? And then selling it at the most opportune time, which we've been very successful with so far. And we use tax mitigation strategies, which I hope all the operators that you invest in are using. The cost segregation, bonus depreciation, and if you can, maybe 1031. After you sell into another deal. So this is our criteria. Typically 100 units or more. 1970s or newer, though we prefer 80s or newer, but sometimes we found the best deals in that 70s range. We just get a tremendous a deal on that. B and C assets, and we only do as of up to now is that multifamily. We're not looking in other asset classes. Our target returns 13 to 17% IRR, 1.7 and 2x multiple. And target hold period is 3 to 5 years. We've sold the 3 deals that we did sell were within 2 years, just taking advantage of that market. I would say typically deals are going to go a little longer these days. We're not going to have that crazy rent growth that we've had the last few years. But we typically underwrite 3 to 5 years anyway. And when we sold early, we just taken advantage of the opportunity. So I wanted to share one of our projects. We bought this at the end of 2021. On the top row, you can see what it looked like before we bought it. So, this screamed opportunity. This was an off-market deal in Tucson, very centrally located. There's a medical park right down the street. A lot of great retail, and it just needed some love. The owner hadn't really done anything to the property in many years. It's a long-term owner, which those are the type of deals that we like to buy. Someone that's owned it for a very long time. That means they haven't put the CapEx, they haven't typically pushed the rents. They've probably fallen asleep on their property management company, or they run it in-house. And as you can see, a tremendous transformation. Changed the name of the property, and Icon is a name that we use at pretty much all of our properties now. So we will say Icon on Pima, Icon on Stella, Icon on Park, depending upon the street name. We did a paint job, new signage, fixed up the pool, new pool furniture. On the third picture to the right on the bottom, there's not a lot of land, but what you could see is putting in some astroturf and some new rock, and it just changed the complexion of the property tremendously. And then we have our interior renovations, and rents went up, like I said, $300-400 at this property, and most of the residents stayed because they knew that they're getting a lot more bang for the buck at this property than the other properties in the surrounding areas. So a lot of them transfer to another unit, and so we can renovate the unit that they were in. All right, with the time. This is another property. This is my favorite renovation project. The pictures don't really do it justice, but it was called San Marin. We changed the name to Icon on Park. Changed the color scheme. The leasing office, you'll see all the way to the right. It was, the top right picture doesn't really show it, but the ceilings were really low. It was dark. We expanded the community center. We fixed up the gym. We had behind me on this picture at the leasing office, we added a door for the gym so residents could get in there 24/7 versus having to only be allowed to get in there during when someone was in the leasing office. So it dramatically changed this property. Like I said, we've been focusing on the Southwest. We've only bought properties in Arizona, but we've been looking in Las Vegas, as well as Albuquerque for over a year and a half, just developing data points. We want to, before we go into any market, we want to have thousands of data points. So it helps us make much more and better informed decisions. So why we love Phoenix, fifth largest city in the US, very landlord friendly, business friendly, tremendous amount of in-migration, very diverse job market, much different than it was in 2008. Rent growth was insane the last few years. Now it's since leveled off tremendously. We actually hadn't been able to buy in the last few years because pricing was insane, but it's since come down quite a bit. Our other adaptive use project was bought in Phoenix about I'd say 19 months ago. It was garden office space that we bought. Out of the existing space, we got 44 units, and we should get our C of O next week. And we're also we built the 3-story. We're all framed up. We're adding 60 new units on this property. And so that'll be finished hopefully January 2024. Tucson has over 1 million people in the MSA. It's about an hour and 40 minutes from Phoenix. Second largest city in Arizona. A diverse job market. You've got the university there, which is huge, but you also have healthcare, defense, some raw goods there. So it's a good, solid market that we feel we have a lot less competition.
Gary, just want to give you a 5-minute warning that we're about there. Just FYI.
Sounds good. I'm in the home stretch.
Awesome.
All right. So investor updates, really important. Our investors have given us a lot of props for how we communicate to our investors. We'll give budget to actual on our financial reviews on a monthly basis. I wish every month was like, hey, we're beating our projections every single month, but that's not realistically. But over time, you'll see that we beat our projections on a consistent basis. We'll have occupancy where it is today, where it was last month. We have a CapEx tracker. We'll upload the rent roll and financials on a quarterly basis in our portal. And we'll tell, we'll talk about if things are any struggles we have, any wins. Nothing goes perfect. We never expect it to be, but we'll talk about the solutions and plan A, plan B, plan C, whatever it is. We're fully transparent on what's going on, and investors typically, they'll reach out to us on when's the next deal, not what's going on with the property, because we're giving tons of information. We'll have a semi-annual call to go over our properties and what we're seeing in the markets. If you reach out to us, we respond right away. And the K1s are uploaded into the portal as well, and we're on it. We're not going to be the company that you're waiting for your K1. I've been there. It's incredibly frustrating. We get these done right away. So typical structure, our minimum usually is 75%. Excuse me, 75,000. We do a 7% pref and a 70-30 split up to 15% IRR, and then we do a 50-50 split thereafter. If someone invests 500,000 or more, you get an 8% pref and an 80-20 split up to 15% IRR. We've typically done 506Bs, so if you're interested in investing with us, please set up a call, and in the last slide you'll have our information on where to set up a call. Our distributions are paid out from cash flow from operations, not from reserves, so you got to make sure. There's a lot of people paying out on a monthly basis from day one. That's not from cash flow, that's from reserves. They'll raise money from you to pay you back, so pay attention to that. And we typically invest in growth markets in landlord and business friendly states with low cost of living. I live in California. I don't want to be a landlord here. I want to be a landlord in Arizona and other places. Here are some testimonials. You can go to our website. You'll see a bunch of testimonials from our investors. And this is how to contact us. You can click on the QR code and go to our website. On our website, you could sign up for our newsletter. You could set up a call with Joe. We also have a lot of resources on the site for investors. Real Estate Investing Guide Made Easy. We also have how to evaluate the sponsor, how to evaluate the deal. We also have a portfolio tracker. If you don't have one, you can download that as well. And feel free to reach out to Joe at his email address, joseph@breakofdaycapital.com. And if there's I've got a couple minutes, so if you have any questions, happy to answer them. But otherwise, you could feel free to reach out to us, and happy to answer any questions you may have.
Great. Appreciate it, Gary. Yeah, if anybody has a question, drop in the Q&A. We do try to keep this tight, so we won't be able to get to a ton, but please reach out to Gary if you do have something specific. But really appreciate the presentation, Gary. Thank you.
Thanks for having me on, Chad.
Absolutely. All right. Not seeing anything pop in. We can always circle back at the end if something does come in, but we'll keep it moving along then. And next up, we've got Anthony Humphress from Eden Companies. Anthony, appreciate you coming on.
Yeah, absolutely. Thanks for having me. Mainly just going to talk a little bit today. I do have a lot of stuff on the website at edencompanies.com. That's EDEN companies.com. But yeah, I'll basically just talk a little bit about our history, how we got going. And I always feel like, they always say you bet on the jockey. And so I feel like just getting to know me a little bit is probably a good thing. So I'll just kind of give my story, my history, talk about our mission and our vision, where we're going, where we are now, talk about the team some, how we invest, and then go ahead and try to answer questions that are probably out there on that with my time. But our mission at Eden Companies is to extend goodwill to our residents, partners, and world through our three values of love, service, and generosity. So literally everything we do kind of runs through that mission. We have something we call a strategic question, which is basically will this help us multiply satisfied residents and partners? And so if the answer to whatever we're about to do is no, then we don't do it. If the answer is yes, then we do it. So we try to stay really focused on multifamily and moving in that direction. But we feel like that's one of the most important things, kind of our mission and our values on that. And we've just briefly on our history, we've grown exponentially since 2001. And I'll tell you more about that. But our basic strategy is we target C properties in A areas of the market that we're intimately familiar with. We reposition those properties and then we basically refinance them for what we call an infinite return model. So I'll kind of unpack that a little bit. But like I mentioned, 2001 is when I got into this gig, bought a house in a neighborhood. I was actually going to get my master's degree in social work, and I was working in this neighborhood with some of the youth. So I bought a house there, made sense, had a couple of buddies that paid me a couple $100 each in rent and helped me pay the mortgage. So that's how I got started. Bought one down the street. And as it turned out, a couple of the spiritual mentors in my life also owned real estate. So they really kind of mentored me in that. And one of them in particular, that was on a golf course. I'm walking down the golf course one day and I see this lot at the end of the golf course. And it's this really ugly house that's kind of grown over with weeds, a Pepto-Bismol type colored house just falling down. Best lot out there. So I went and I grabbed my older mentor and I told him, hey, if we could get this together, I'll work on it. You put up the money. And so he really helped me through that. And that's when I kind of learned the process of buying something, fixing it up, getting it rented, repositioned, refinancing, and kind of pulling your money out, and then kind of keeping the property so that you can maintain that cash flow. Somebody else is paying your mortgage down, the property's appreciating, and it's all very tax friendly. So I'm sure everybody listening in is kind of aware of all the advantages of investing in real estate, but learned that a long time ago. And then I think something that's important at Eden Companies is, so that all happened 2001 and 2003. And in 2003, I actually wanted to move overseas, work with nonprofits overseas, and said a very genuine prayer sitting beside the second house I ever owned. Well, 2.5 because of the one that God helped me buy. And it was basically, hey, God, if you can help me get a few more of these rental houses, I'll have enough cash where I can go overseas and do this other work. And so I feel like that's when Eden Companies really started. So I never had a plan to get into real estate, to be wealthy, to be a business guy. I say we kind of started, we wanted more rental income in order to change the world. And so that's really what we stand on now is my wife and I actually cap kind of what we make and take out of the business. And we're very generous with the rest. We pay our team members well. We're generous to the community and the world. And I just think that's important to me. It's what drives me. I always say if, I'd just retire and move to Florida and live on the beach, but what drives me is really creating extra income so that we can give back. So that's kind of the history, the start of it. Our current position, we own 726 units right now. It's about 100 million, a little over 100 million in assets under management currently. Our vision is to purchase about 4 billion worth of multifamily assets and to add value to those and see them appreciate to about 5 billion. And as the GP side of that, Eden Companies would like to steward about $1 billion of that. So we're figuring that's a target of about 150 apartment communities overall. So we've got a gap there, right? So we focus in Lexington, Kentucky right now, Central Kentucky area. We are about to close on a deal about an hour away. But we love Lexington, a lot of horse farms around Lexington. So they have what's called the urban service boundary line. So you can't develop into these horse farms. So it's somewhat landlocked. It's easy in Lexington for an outsider to come in and think they may have found a deal that's maybe really not a deal. So I'd like to brag that I'm intimately familiar with the area. I've lived there since '96. So it's a great area. Like I said, our goal is we focus on these C areas and we transform these communities. Or I'm sorry, we focus on A plus areas. We buy a C product and then we kind of transform that product. So that's really been our niche, and that's our plan, is to just exhaust our opportunity there in Lexington. And once we've exhausted that opportunity, probably stretch out about an hour, hour and a half towards Louisville, towards Cincinnati, that kind of thing. Reason being, we self-manage everything. We've got our own property management company. We own our own construction company. We even own our own heating and air company. So we like to kind of keep everything in-house, maintain control of it, and make sure we can serve our residents well. So that's our plan. Talk about the team a little bit. I've got Bill Eister is my COO, and you can read more about him on the website, but he worked about 20 years. He ran the US division for a Fortune 50 company, very gifted in operations, moved over and ran a large nonprofit for about 10 years, moved back to Lexington in 2015. And that's when I met Bill. He came on the team a little over, I think over 2.5 years ago now. And he's just a very, very gifted operator. Not only, I like to say, not only does he have his MBA, but he's actually got his PhBA. And so he knows what he's doing. So when he came on, the plan was to help me scale up and do syndications because I kind of hit a fork in the road. And that's worth noting with LFI. That's how I got involved. Is initially I was going to be an investor. My brother-in-law is heavily involved and sells medical supplies, and he had me convinced that, man, I don't have to manage this stuff. I don't have to take phone calls about toilets and have all the hassle. Don't even have to go out and raise the money, which we found very easy in my relationships around Kentucky. A lot of people know me and trust me, so it's been very easy for us to raise money so far. But it's kind of like all I have to do is make investments. So I was really thinking about that path and hit a fork in the road where I was either going to go down that path or I was going to build out this property management company, construction team, and go the route of syndicating. And I obviously chose the latter, and Bill's really helped scale that up. So we're looking forward to a lot of future growth on that front. But with Bill, he took a company a few years ago at 17 million in revenue and grew it to over 100 million in a couple of years. And the CFO that was with him on that team came over to our team as well. Very gifted young man. And I've already mentioned the construction company. We've kind of groomed another young man in property management who acts somewhat like a regional property manager. And he's really gifted. So we're just growing that team out. But again, you can pick all that up on our website. So how we invest, I kind of mentioned that already. I know some people have referred to this as being a lazy syndicator when you don't sell something and roll it into a new deal. But I've always kind of had the philosophy, it's like the geese laying golden eggs. And if I can buy the next goose without killing the last one, then why wouldn't I? And that's worked so far for us. So we like to keep the goose and just add more and more. And we've been able to do that fairly easily. So that's our strategy. So if you invest with us, typically there will be a refinance at some point. Our most recent fund, we plan on doing that in less than 3 years. The fund before that, it's actually a 7 to 10 year mark. Reason being is we were fortunate to lock in financing for 10 years under 4%. And so we're going to take advantage of that and hammer that debt down. And then in 10 years, we'll do a refinance and people will make a lot of money. So in our first fund, so we've done 3 funds so far. On our first fund, we did sell that one out. And I think that came out at a 26% annual average return on investment for that fund. So we're probably not the biggest syndicator out there, but we're very, very focused. And because we're not the biggest, we're really picky about our deals. And so it's almost like when you invest with Eden Companies, you get in on the ground floor. The more and more we figure this thing out, perhaps the perhaps the greedier we'll get with our terms and returns and that kind of thing. But so far, we've done 8% preferred returns on an 80-20 split. And then on some of the deals, there's a catch up. Some of them there aren't. On the last two, there is, once you hit a certain hurdle, the split does adjust on those. But we feel like they're very generous returns. I like to sleep at night, so I usually underpromise what's going to happen, and people have been happy so far. As far as minimum, I have done funds at 50,000 minimum. Our last one was 100,000. You do have to be accredited to invest in our funds. Full deal cycles. So I've been doing this, like I mentioned, since 2001. My first real partner was in 2015. Our first syndication that we closed on was actually January 1st of 2020. That's the one I mentioned that closed and produced the 26% return. And we've done the two others since. So let me see. And I mentioned too, geographically, we love Lexington area, probably spread from there. As far as enhanced terms for the LFI community, I know I think it's called tribal investment groups. And so, of course, we're very open. If a group of people come together and form one of those to meet the minimum or more, then that's fantastic. Happy to do that. So that's a load of information. I have a lot of time left here, so happy to keep it short or answer any questions there might be.
No, that's good. Yeah, if anybody has any questions, feel free to drop them in the Q&A. Appreciate you mentioned, I was trying to think through some things as you were going through. Could you talk about the debt structure a little bit more, what you usually look at? That's a hot topic these days with interest rates where they are and everything else. What do you guys usually do with your assets as you're filling out the debt side of things?
Sure. So the first fund that's closed out, let me think, the first one, second, and the third, I use local bank financing. I lock in the rate as long as possible for as low as possible, just for safety purposes. And then the plan is, once we turn the property around, we'll refinance that, because for me personally, I have assumed Freddie Mac agency debt. And so I'm qualified for that debt and meet all those requirements. And so once we have these properties turned around, we'll go ahead and refinance them out on agency debt, lock it in as long as possible, 10 plus years on a 30-year AM. And that's the plan. On some, I own two other communities personally as well that I've not syndicated. For those, we've actually used a credit union conglomerate. There's no early term payoff on that, and it's friendly terms on the construction loan part to permanent, decent rates on that. But I locked that in as long as I could too, knowing that I can turn around if I want to refinance it to agency debt and get that kind of 10-year, 30-year money. So that's generally how we do it. And of course, Gary mentioned, I appreciate him mentioning, you raise so much money that you're paying your distributions out of your raise. So we obviously try not to do that. We keep our raise to where it'll cover our closing costs, down payment, and have a little bit of a cushion. But we try to immediately start producing cash flow. We do quarterly distributions, quarterly financials. So available on the phone, of course, that kind of thing. So.
No, that's good. How many assets do you try to put in a fund of the three? I assume maybe it's grown through the time, but What are you
Yeah.
usually looking at? Just curiosity.
It has grown. Yeah, the first fund was decently small. The second one was 322 bedrooms around the University of Kentucky because I got started in student housing. Love student housing because you pre-lease so far in advance that, in my opinion, you're kind of lazy if you're not 100% occupied. And of course, students typically pay, or their parents. And so those 322 beds consume that second fund. This third fund that we just actually fully subscribed to, it's 110 units, 216 beds around Morehead State University in East Kentucky. School's got about 10,000 students, and they've got about 3,000 beds that they offer. So there's a bit of a gap there. Of course, not all those students are full-time. Some of them are online. So that'll be the foundational deal in this third fund. But then I'm trying to buy up a lot of 12, 24 unit buildings in a contiguous area of Lexington that I really like. It's really an A+ area, but these buildings have not been managed well. They're very old. And so the plan is to try to buy up those buildings for future redevelopment. So we kind of, you kind of have to get creative sometimes in how you structure deals and do things to make it work for everybody. So we're pretty creative in how we do that and try to make things work out. So
well, that's great. Cool. Still no questions coming in. I don't know, any other highlights you can share with us? You covered a good gamut. What was your contact information again? Let's make sure that's on here as well.
yeah, so my personal number is 859-229-4991. And then email is Anthony, Anthony, at Eden, EDEN, companies.com. And of course, our website is edencompanies.com.
Awesome. If you want, Anthony, even drop that in the chat and then we'll have it in the recording so it'll go out too.
Sure.
Because I think the chat's set up to go to everybody. So that'll be helpful too.
Perfect. Yeah, I'll do that.
Cool.
All
Very
right.
good. Well,
Thanks for
again,
coming.
appreciate you coming on, sharing the information. Sounds like an interesting story you've got there too, in the Lexington area. Beautiful area. So happy that you came on to share all that with us today. Thank you.
Thanks, Chad.
Yep. So our third member today of the LFI Scouting Report is David Zeff from Sterling Real Estate Partners. David, thanks for coming on. Feel free to share your information with the community.
Hi, Chad, and thank you for having me. I just have one programming note for you guys. Continue with the baseball theme is perhaps when you introduce your guests, we could get like a walk-up song.
You want a walk-up song? Very
I want
good.
a walk-up song. I mean, what middle-aged adult doesn't want a walk-up song?
There you go. We'll put that to mind. I like that. That's a good advice.
Anyways, when I came across your platform, I thought it was really, really interesting on what you guys are doing, but also the organic growth of the platform and how you guys have all come together and everybody kind of has a common goal of investing in real estate and really understanding how do people put their money to work outside of the stock market. When I started in the business in 1992, real estate was an alternative asset class. It was an alternative asset class on the institutional level. And if you were a high net worth individual, you were probably investing in a lot of the oil general partnerships and syndications in the 70s and 80s, and had just got burnt on a lot of the Tax Reform Act in 1986. And if you were a wealthy individual or accredited investor, as they are defined today, you didn't have any options really to invest in real estate. You kind of had to know somebody, but it was that alternative asset class. And what you guys are doing is really opening it up to everybody that doesn't have those resources or those contacts. And I think that's certainly where we're taking our platform. When I originally started as I said, in 1992, I cut my teeth working for two real estate investment companies. One was primarily a downtown San Francisco based commercial investment company where we had Prudential as our operating partner, and the company was up fully integrated, as we call a sponsor today. And that was where I really learned the entrepreneurial side of real estate investing. And it was also the time pre-internet. And so you really had to have the relationships, and you had to understand the true fundamentals of real estate, where I learned a lot of the principles that we still employ today. And I teach all of our staff, and things such as, your customers are your tenants. If you don't have happy customers, you're not going to have tenants that are going to continue to stay in your property. Relationships matter. As I said back then, if you wanted some information on a site, you had to go to happy hour. All the brokers and everybody were friends. You intermixed, and if you wanted a comp or you wanted some information, you had to know all of your peers in the business. And then I went and worked for a company that was the opposite of the kind of sponsor operating model. It was a company that was all completely internally capitalized. And there's where I realized, how do people really think with their own money, and how do they invest for their own account? And there I learned some incredible valuable lessons. One of them, which I'll absolutely never forget, is we would have hard money, non-refundable deposits on assets, and we'd be negotiating loan documents all the way up to the funding date. And if they couldn't get the terms that they wanted, they would walk. And as a young professional, I couldn't understand, how could you do that? And it was right. That was the traditional sunk cost. And if it's not going to be a good investment, don't put good money in after bad. And so a couple of just really incredible experiences that I had, which led me to start my company in 2005 in Northern California. I wanted to get back to that entrepreneurial environment, and I like the idea of creating value in our investments and for our investors. And so I went back to that institutional equity partner LP model, where we were the operating sponsor. And from 2005 to 2010, it was primarily all office and commercial in Northern California. And we had the institutional capital partners back when GE Capital when they were a real company. Well, they actually were one of the biggest companies in the world back then. They were making real estate investments into local operating partners, people that were geographically defined and product defined. And so I learned from the beginning how to execute at the institutional level. And what we also did was on the general partner side, we started to syndicate some of the equity to just friends and family, people that wanted to be in real estate. So we have this hybrid on a model of institutional execution, but we're also bringing in accredited investors. And that continued to grow as we matured as a company. We went through the darkest of times through 2008, 9, and 10. And that was when I made the switch from commercial to residential, realizing the housing is a need asset, and it has a lot of elasticity to demand. You can improve units if you want to achieve higher rents. You can drop your unit and lower your rents and attract units. And so that was, as I said, is when I made the switch to residential. We started in California. Then we went to Nevada, where we quickly realized we wanted to be in business-friendly states where if a resident doesn't pay rent, you have the ability to get your real estate back within generally the same month that they don't pay. Whereas in California, I think we all know it can take a lot longer. It'd be a lot more costly. So we went from Nevada, we started investing in Arizona, we started investing in Texas, and in 2015, I relocated with my family to the Phoenix area, and we've been here for the last 8 years, exclusively focused on a multifamily platform. And so what we offer is more of a boutique investment company. We are not a high volume company. We're not interested in just acquiring assets and capital deployment. We are investing for our own account, but we're also investing with a fiduciary, either with our institutional partners or with our high net worth accredited investor base. And so we're looking for opportunities where we can make money. And that's really the platform of the company. We were really asset heavy between 2014 and 2019. And in 2020 and 21, we became more asset light, realizing that valuations were exceeding really our justification and where we thought the market was what we would pay for an asset. So we've always had kind of the philosophy of don't fall in love with your real estate. If someone's willing to pay us more than what we think it's going to be worth, then we're going to trade it. And so we ended up trading most of our assets between 2020 and early 2022. And assets that we were buying during that time, we were kind of trying to mine the market to try to find where we thought were good opportunities. One of our core tenets is we don't buy assets above replacement costs. And in the Phoenix market, assets were 80s assets were trading at well above replacement cost at $350,000 per unit. And Class A assets were in the $500,000 per unit range. So we were just looking for other opportunities where we could find value in the market. And during that time, we bought a couple of hotels to renovate and to turn into more affordable housing. And we bought some opportunity zone land. So as the market has started to kind of come back down and asset pricing is now off probably at least 30% in some markets, in some cases, that we are looking forward to getting back to our bread and butter, which is buying existing assets with a value add or value enhancement platform. And I think this is an opportune time for the accredited investor to really get into the market, because the institutional capital is out of the market and the market fundamentals are still really strong, but the institutional capital really invests with the herd mentality and they're basically risk off. If I work at an institutional or private equity firm right now, there's more risk for somebody to do to make an investment, propose a transaction, advocate for something, because if they're wrong, they are dead in the water. And again, a lot of these, so the institutional market is they're kind of risk off, and I think it's a good time, as I said, for the accredited investor to get into the market. And so we're looking to grow our accredited investor base so we can build that war chest, because in this environment, cash is king, and being asset light puts us in a good position to find the right opportunities and make some investments when we feel that they're priced right. So I have some slides that I will run through with just kind of an overview of the company. I can find the share screen. Chad, is that sharing out?
I don't see anything yet. No. Should have the share screen button down in the middle there. It's coming up. There you go. You're good now.
As I say, we speak multifamily. That is all we do. We are, as I said, I've been in the business since 1992. We are just dyed in the wool real estate company. We're fully integrated, which allows us not only to provide the highest level of service to our tenants, but it allows us to have streamlined communication and decision-making at our assets, and really helps us implement the business plan for each particular asset. As I said, relationships matter. I started the company in 2005, and in this market, strong relationships are what is going to lead to opportunities, both at the asset level, but also in the financing and banking level. If you don't have relationships with your existing banks, if you have issues, you need somebody to talk to, and you need to have experience and credibility with your lenders so you can get any sort of accommodation or workaround or any modification that you may need. We believe in alignment of interest. So not only do we have a traditional promoted investment structure where we are only receiving percentage of the profits after certain internal rate of return hurdles. The principals, and we allow all our employees to invest in every asset. So even if you are a property manager on our sites, we feel it's important to give them an opportunity to not only better their lives, but to invest in the asset so they truly have skin in the game. We also have at least a 5 to 10% net equity investment in the asset. I think that's important when your listeners and accredited investors are looking at capital structures and sponsors, that net equity investments is a real thing, and it's certainly something that is meaningful, and it's something that we do on every asset. We have, as I said, in-house property management. We're fully integrated property management, accounting, construction management. All those things have all of our interests in alignment. Our process is fairly straightforward, nothing really super revolutionary, where we are constantly evaluating all types of multifamily assets. We buy things that are in the 60s, built in the 60s, and we buy assets that are built in the 2000s. It just depends on where the value proposition, where the opportunity is. Don't employ high leverage capital structures. We never really have. It's something that I learned early on, that you have to be prepared for when the market shifts and the market changes. Again, our focus, this just shows where we've been: California, Nevada, Arizona, and Texas. Currently, we are focused on the Arizona and Texas markets, primarily Phoenix. We do have a hotel conversion project in Tucson. And in the Texas markets, we're primarily focused on San Antonio. We are primarily focused on Austin. We had been in San Antonio, but it's not going to be a market of focus for us. Again, moving forward, we're focused on the high growth markets of Austin and Phoenix. Our platform, we deploy 3 investment strategies. As I said, the traditional value add platform, where we're buying an existing asset, and we are going to deploy either a capital improvement strategy or a management strategy, or a lot of times both, to create value at the asset level. We have an adaptive reuse platform where we can, if we feel there's an arbitrage at the really bricks and sticks level of the underlying real estate, if we can buy a hotel or an office building, that will change the use to multifamily. And then development. When we see the market moving where assets are trading above replacement costs, then development becomes a better option. Why pay $325,000 for a 1980s asset when you can build a brand new asset for less? And so we are currently working on an opportunity zone development in the Phoenix market. So the company is myself, Leanne Schofield, who's a partner in the company. She's been with me for almost 10 years now. Extremely deep operating background, primarily through property management and Greystar. Nick Rowe is our development manager. He's developed thousands of units here in the Phoenix market. And Wendy is another 30-year veteran of real estate, all on the accounting side. So she is extremely strong there. To get in touch with me, you can reach me at david@sterling-partners.com. There's my phone numbers and the website. You can go to the website where we have a contact us page where we can enter your accredited investors can enter their email information to get on our monthly newsletter, to get into our investor database, to start to see our deal flow whenever we're out marketing. So I have a couple of other things that I can share as well. We have some case studies on a project. This is a really great project we did here in the Phoenix market. Is that coming up?
Yep, we got it up now.
There we go. This is a project called 7th. It was a project that was owned by really a nonprofit for about 20 years. They had 80% of the units were market rent units, and 20% had to be within a 60% AMI. The property needed significant renovations, and so we changed the entire profile of the asset. Over a 2-year period, we brought in our own management company to bring in professional property management. And so these things are all available for any of the accredited investors, but it's a real quick kind of comparison of how we had modeled the asset compared to the actual metrics of internal rate of return, equity multiples, gross income, NOI, and some of our investment highlights of really the value creation and the rent story that we created. So I finished a little bit early.
Great.
But we could chat about anything real estate, or if there's any other questions.
Yeah, again, we'll just throw out if anybody has any questions, feel free to drop them in the Q&A, but good stuff. Appreciate David, you sharing that information with us. Let's see, you mentioned accredited only. I was trying to think if there's any. What about debt structure with you? What type of debt structure do you guys usually look at when you're setting these up too?
Yeah, it depends on the asset profile. It's a balance between trying to maximize leverage, but maintaining enough debt coverage ratio. In the past, we really like the Freddie Mac agency floating rate loan, because it's a 7-year term, but because it's a floating rate product, you have some flexibility on the prepayment. And so you kind of get the best of both worlds. So you'll have to cap the interest rate, which can be an issue for people right now if things aren't capped or if caps are expiring. But we really like that product again, because it provides the flexibility. If we want to exit, we're not hamstrung with a large prepayment penalty.
Yeah.
But I think going forward, as I said, I think now is the right time for the accredited investor. And I think the entry point on some of these assets right now is really favorable. And what we're looking to do is to move up an asset class a little bit. If we can find higher quality assets that are going to have less long-term deferred maintenance, and going with a 5 or a 10-year fixed rate loan to take that interest rate risk out of it, but have some flexibility to be able to refinance out in 3 years, 2 or 3 years, if interest rates move down and asset fundamentals improve, and we're able to refinance out some equity, but continue to fix that interest rate and have that interest rate stability.
Very good. Very good.
So,
well, I don't see any questions, but we're right about at time. So we'll pause here. Again, thank you to Gary, Anthony, and David, all for coming on and sharing your information today. Really appreciate that. The contacts information's in the recording. Anybody feel free to reach out to any of these gentlemen if you have any questions. But fellas, really appreciate you coming on and sharing your stories with us.
great. Thanks for having us.
All right. Thank you.
Bye-bye.
Said.
See you guys.